the markets was pretty spot on, I would say, on credit loss expenses, and that were mainly driven by models assumptions that we have to put into our calculations for credit provisions. And I think the market underestimated that activity levels in the second quarter was very robust. We had a very strong results in our Asian wealth management business, which was up 70%, in Europe 16%, and also in Switzerland. We had very strong performance in our asset management business with very strong inflows, and last but not least, also our investment bank had a very strong results in the second quarter in FX, in rates, but also in cash equities and in prime brokerage, offsetting some headwinds that we saw in the US based on recurring fees being below the previous quarter based on the asset levels at the end of Q1.
Obviously, the market is very concerned about the likely level of credit losses going forward. Can you just tell us what you're anticipating for the third quarter and what you're modelling for in terms of loan losses going forward from here, and whether you feel you may need to provision further?
Well, one has to make a lot of attention in making provisions in this environment, because the possible outcomes are still very difficult to predict. Having said that, for the second half of the year, we are modeling, the severe recessions that everybody is expecting, and with a mild recovery into 2021. Our model also has a 30% weighting in a very severe stress situation coming in the next 36 months. So overall, that lead us to expect elevated credit losses for the second part of the year, but below what we saw in the first half of the year.